The US stock market has again reached the all-time high. Investors were encouraged by the US labor report, which unveiled that the country's economy added more jobs than expected. However, the rise is not sufficient to cause a surge in inflation. At the same time, the US dollar index, which measures the US dollar against a basket of 6 major currencies, managed to jump to a 3-month high last week. Demand for the US dollar remained high amid the Fed's announcement to raise the key interest rate twice by the end of 2023. Christopher Waller, a member of the Federal Reserve Board of Governors, noted that the regulator might have to cut the asset purchasing program this year to fulfill its plans concerning the benchmark rate. Nevertheless, on Friday, the US dollar dropped amid the fact that traders were locking in profits on buy positions at the end of the month. What's more, positive data on the labor market caused interest in riskier assets and pushed the greenback down as a safe haven asset. As a result, the euro-dollar pair rebounded from its lows. The fact is that during the week, the euro slid to its lowest levels last seen in early April. The decline took place amid the dovish comments provided by the ECB and an unexpectedly hawkish announcement made by the US Fed at the June meeting. At the same time, according to the data, the Eurozone manufacturing PMI hit a new record high in June, and the unemployment rate slumped to a yearly low in May, thus pointing to the confident economic recovery. The euro-dollar pair closed the previous week with a 0.6% drop. Notably, investors are preoccupied with the spread of the Delta variant of COVID-19. Such countries as the UK and some European countries may reintroduce the lockdown measures. Although the Bank of England's rhetoric is much like the ECB, the pound sterling showed a better performance than the euro. Thus, during the week, the pound sterling lost 0.45%, but in June it depreciated by 2.8% against the US dollar. This was the worst month for the currency since September. Meanwhile, traders of cryptocurrencies are still waiting for significant news that will allow Bitcoin to leave the channel between $33,000 and $40,000. Last week, the asset was also trading sideways. Oil prices also remained at the levels logged at the beginning of the previous trading week. Importantly, these levels are located near the high of $76 per barrel last seen in October 2018. Traders' sentiment was significantly influenced by the OPEC Plus decision. The countries agreed to raise oil production from August 2021 and extend remaining cuts to the end of 2022 instead of April 2022. However, the UAE blocked some aspects of the pact. Investors fear that the failure to reach an agreement could mean that major producers will keep the oil output at the current levels, while some OPEC Plus members may begin producing more crude oil. Let's switch to gold now. Since mid-June, gold has been trading below $1,800 per troy ounce. This is well below a 5-month high of $1,900 reached at the beginning of June. Investors avoid buying the precious metal amid the US dollar strength and prospects of global economic growth. The fact is that more and more people are receiving their doses against COVID-19, and the Fed is manifesting its intention to tighten the monetary policy in the near future. Thus, in June, gold slid by 7%, showing the worst monthly dynamic since November 2016. Nevertheless, the decline was capped by the spread of the Delta strain of COVID-19 and travel bans across Europe and the Asia-Pacific region. You've watched the combined review of financial markets on InstaTV with me, Anna Kasatkina. Stay tuned.